Look, I need you to pause whatever you're doing right now because what I'm about to share could save you from making a costly mistake. And I don't say that lightly. Silver just hit levels we haven't seen in years. Everyone's talking about it. Your neighbor's buying it. That guy at work won't shut up about his silver stack. And you're sitting there thinking, maybe I should get in on this. But here's what nobody's telling you. There's something happening beneath the surface of this market that changes everything. And if you don't understand it before you buy, you could end up on the wrong side of one of the biggest wealth transfers in modern history. Let me show you what I mean. Right now, silver is trading in a range that has institutional investors absolutely salivating. But it's not for the reason you think. See, when most people look at silver, they see a shiny metal that goes up and down. They see headlines about industrial demand or solar panels or electric vehicles. And sure, that's part of the story. But the real story? It's about a structural deficit that's been building for 5 consecutive years. We're talking about 820 million ounces of deficit accumulated over that period. To put that in perspective, that's more than half of annual global production just gone, vanished from available supply. Now, you might be thinking, okay, supply deficit, got it. That means prices go up, right? So I should buy now. Not so fast. Because here's where it gets interesting. Despite this massive deficit, despite industrial demand hitting record levels, despite every fundamental indicator screaming that silver should be significantly higher, the price has been remarkably controlled, managed, suppressed, if you want to use that word. And that's not conspiracy theory talk, that's market structure. Let me explain. The silver market operates on 2 levels. There's the physical market, where actual metal changes hands. Bars, coins, industrial deliveries. Real stuff you can touch. Then there's the paper market, where contracts representing silver trade on exchanges like the COMEX. And here's the thing. The paper market is roughly 100 times larger than the physical market. Think about that for a second. For every ounce of actual silver that exists, there are 100 paper claims on that same ounce. It's like a game of musical chairs where there's 1 chair and 100 people playing. Eventually, the music stops. Now, why does this matter to you right now? Because we're approaching a moment where the paper market and the physical market are about to have a very public disagreement. And when that happens, the price discovery mechanism is going to break in a way that benefits one group of people and absolutely devastates another. Let me tell you a story that illustrates this perfectly. Back in the early 1970s, silver was trading around $1.50 an ounce. The Hunt brothers, a couple of Texas oil billionaires, looked at the fundamentals and realized something. They saw that industrial demand was growing, supply was constrained, and the price made no sense. So they started accumulating. Not just buying futures contracts, but taking physical delivery, actual metal stored in warehouses. At first, nothing happened. The market absorbed their buying, but they kept going, month after month, year after year. And slowly, other investors started noticing. The price began to move. $5, $10, $20. By early 1980, silver hit $50 an ounce, a 33x return in less than a decade. But here's what's fascinating. It wasn't just the Hunt brothers buying that drove the price. It was the panic that ensued when the market realized there wasn't enough physical silver to satisfy all the paper claims. Dealers scrambled, industrial users hoarded, the whole system nearly broke. Now, the Hunt brothers' story ended badly. They got over-leveraged, the exchange changed the rules mid-game, and they were forced to liquidate. But the lesson isn't about their downfall. The lesson is about what happens when paper claims exceed physical supply by too much. And we're there again. Except this time, it's not 2 billionaires driving the squeeze. It's central banks. It's industrial demand that can't be turned off. It's a structural deficit that's been building for years. Here's what's happening right now that most people don't see. Central banks have been net buyers of precious metals for 15 consecutive years, but recently, something shifted. They're not just buying gold anymore. They're diversifying into silver. Why? Because they understand what's coming. They see the same supply deficit we're talking about. They see industrial demand from solar, from EVs, from AI infrastructure. They see a metal that's both a monetary asset and an industrial commodity, and they're positioning accordingly. Meanwhile, industrial users are getting nervous. Solar panel manufacturers need silver. Every panel requires about 20 grams. With solar installations projected to double over the next few years, that's massive demand that can't be substituted. Electric vehicles use twice as much silver as traditional cars. AI data centers require silver for their electrical components. This isn't discretionary demand. This is demand that has to be met. And then there's the investment demand side. ETFs have been accumulating. The largest silver ETF has seen inflows that would have crushed the price in a normal market. But the price has remained relatively stable. How? Because the paper market has been absorbing the pressure. But here's the problem. The paper market works great until everyone wants physical delivery at the same time. And we're starting to see cracks. Premiums on physical silver have been elevated for months. When you go to buy actual coins or bars, you're paying significantly more than the spot price. That spread, that premium, is telling you something. It's telling you that the physical market is tighter than the paper price suggests. Delivery delays have been increasing. Mints are running behind. Dealers are struggling to source inventory. These are the early warning signs that the two markets are diverging. Now let me show you why timing matters here. If you buy silver right now, at current prices, without understanding what's about to happen, you could end up in one of two scenarios. In the first scenario, you buy physical metal, the squeeze intensifies, and you're positioned perfectly. You own real assets that can't be printed, can't be diluted, and are in genuine short supply. In the second scenario, you buy paper silver, thinking you're getting exposure to the same thing. Maybe you buy a futures contract or shares in a leveraged ETF or some other derivative product, and when the squeeze happens, when physical demand overwhelms paper supply, you discover that your paper claim isn't worth what you thought. Because in a crisis, paper promises and physical metal are not the same thing. This isn't theoretical. We've seen this play out in other markets. In nickel, a few years back, the London Metal Exchange had to halt trading and cancel trades when a short squeeze got out of control. In palladium, we've seen massive disconnects between paper and physical prices. It happens. And when it does, the people holding physical assets win and the people holding paper promises lose. So here's what you need to understand before you make any move. The silver market is at an inflection point. We have a structural deficit that's been building for years. We have industrial demand that's accelerating. We have central banks positioning. We have a paper market that's massively over-leveraged relative to physical supply. And we have early warning signs that the two markets are starting to diverge. But, and this is crucial, we also have a market that's been manipulated and managed for decades. The big banks, the commercial traders, they know how to play this game. They can push prices down when they need to. They can trigger stop losses. They can shake out weak hands. So if you're going to buy silver, you need to do it right. You need to understand what you're buying, why you're buying it, and how to position yourself to benefit from what's coming rather than getting caught in the crossfire. Let me give you a framework for thinking about this. First, understand the difference between investment and speculation. If you're buying silver as a speculation, trying to time the market, trying to catch the next move, you're playing a dangerous game. The market can stay irrational longer than you can stay solvent. The big players can push prices around. You can be right about the fundamentals and still lose money in the short term. But if you're buying silver as an investment, as a long-term store of value, as insurance against currency debasement and financial system instability, then short-term price movements don't matter as much. You're positioning for a multi-year trend. You're building a position that benefits from the structural forces we've been discussing. Second, understand the form of silver you're buying. Physical metal, coins, and bars gives you direct ownership. No counterparty risk, no paper promises. But it comes with storage costs, insurance considerations, and liquidity constraints. You can't sell a silver bar as easily as you can sell a stock. Paper silver, ETFs, and futures gives you price exposure without the hassle of physical ownership. But it comes with counterparty risk. You're trusting that the institution holding the metal actually has it, that they'll honor their obligations, that the system won't break when you need it most. Mining stocks give you leveraged exposure to silver prices. When silver goes up, Mining companies' profits can go up even more, but you're also taking on company-specific risk, management risk, operational risk. A mine can flood. A CEO can make bad decisions. Governments can change tax policies. Each form has its place, but you need to understand what you're getting into. Third, understand the timeline. If you're buying silver expecting it to double next month, you're probably going to be disappointed. Markets don't move in straight lines. There will be pullbacks. There will be periods where nothing happens. There will be times when you question whether you made the right decision. But if you're buying silver as part of a multi-year thesis, understanding that we're in the early stages of a structural bull market driven by supply deficits and industrial demand, then you can weather the volatility. You can add to positions on dips. You can build a meaningful allocation over time. Now, here's something most people don't consider: the opportunity cost of being wrong versus being right. If you buy silver and the price goes down, what's the worst that happens? You own a physical asset that's been money for thousands of years. You own something that has industrial utility. You own something that can't be printed or diluted. Sure, the dollar value might be lower temporarily, but the metal itself hasn't changed. But if you don't buy silver, and the squeeze happens, and prices go vertical like they did in 1980, what's the cost of missing that move? What's the cost of watching from the sidelines as one of the biggest wealth transfers in modern history unfolds? That's the asymmetry you need to think about. Let me share another story that drives this home. In 2008, during the financial crisis, silver crashed along with everything else. It went from around $20 an ounce down to $9. People panicked. They sold. They thought the world was ending, and precious metals were just another asset class getting destroyed. But the smart money did something different. They looked at the fundamentals. They saw that the crisis was being solved with money printing. They saw that central banks were expanding their balance sheets. They saw that the structural issues in the financial system weren't being fixed, just papered over. And they bought. By 2011, silver hit $49 an ounce. The people who bought at $9 made 5x their money in 3 years. The people who sold at $9 missed one of the greatest trades of the decade. The lesson? Markets can be irrational in the short term. Prices can disconnect from fundamentals. But over time, supply and demand win. Structural forces win. Reality wins. And the reality right now is that we have a silver market that's fundamentally broken. We have more paper claims than physical metal. We have industrial demand that's accelerating. We have a supply deficit that's been building for years. We have central banks positioning. We have all the ingredients for a major repricing. But here's the thing. The market knows this. The big players know this. They're not stupid. So why hasn't it happened yet? Because the paper market is a control mechanism. As long as price discovery happens on the COMEX, as long as futures contracts can be settled in cash rather than metal, as long as the system can create infinite paper claims on finite physical supply, the price can be managed. But that control mechanism has limits, and we're approaching those limits. When industrial users can't get the metal they need, they stop trusting the paper market. When investors demand physical delivery and dealers can't source it, the premium explodes. When central banks decide they want metal instead of paper promises, the whole structure breaks. And that's what's starting to happen. Slowly at first, then all at once. So here's what you need to do before you buy silver. 1. Educate yourself on the difference between paper and physical. Understand what you're actually buying. Understand the risks and benefits of each form. 2. Decide on your timeline and your thesis. Are you speculating on short-term moves or investing in a long-term structural trend? Your answer determines your strategy. 3. Consider your allocation. How much of your portfolio should be in silver? That depends on your risk tolerance, your financial situation, your other holdings. But it should be a meaningful amount if you believe in the thesis. Not so much that you can't sleep at night, but enough that it matters if you're right. 4. Think about storage and security if you're buying physical. Where will you keep it? How will you protect it? What's your plan for eventually selling it? 5. Understand the tax implications. Different forms of silver are taxed differently. Physical metal might be considered a collectible. ETFs might have different treatment. Know what you're getting into. And 6, have a plan for what you'll do when the price moves. Will you add on dips? Will you take profits on spikes? Will you hold through volatility? Decide now, before emotions get involved. Now, I mentioned earlier that there's a way to position yourself in silver through retirement accounts. And this is actually crucial for a lot of people because the majority of their wealth is locked up in 401ks and IRAs. They can't just go buy physical silver with that money under normal circumstances. But there's a structure called a gold IRA, which also allows for silver, that lets you hold physical precious metals in a tax-advantaged retirement account. If you've got $100,000 or more in retirement savings, this might be worth exploring. I put together a free guide that explains how it works, how to set it up, what the rules are. It's in the description if you want to check it out. The reason I bring this up is because a lot of people don't realize this option exists. They think they have to choose between their retirement savings and positioning for what's coming in the silver market. But you don't. You can do both. Anyway, back to the bigger picture. The silver market is at a critical juncture. We have all the ingredients for a major move. But timing markets is nearly impossible. The squeeze could happen next month. It could happen next year. It could take 5 years to fully play out. What we know is that the fundamentals are in place. The structural deficit is real. The industrial demand is real. The paper market leverage is real. The question isn't if there will be a repricing, but when and how violent it will be. And here's what makes this particularly interesting right now. We're not just talking about silver in isolation. We're talking about silver in the context of a broader shift in the global monetary system. Central banks are diversifying away from dollars. Countries are settling trade in alternative currencies. The BRICS nations are talking about a commodity-backed currency. Gold is being revalued on central bank balance sheets. We're in the early stages of a fundamental restructuring of how the global financial system works. And in that context, silver isn't just an industrial metal. It's not just an investment. It's a monetary asset. It's been money for thousands of years. It's in the Constitution. It's what people turn to when they lose faith in paper currencies. So when you're thinking about buying silver, you're not just making a bet on supply and demand. You're making a bet on the future of money itself. You're positioning for a world where physical assets matter more than paper promises, where real things have value independent of what governments say they're worth. That's a big thesis, and it might sound dramatic. But look at what's happening around the world. Look at the debt levels. Look at the money printing. Look at the inflation. Look at the loss of purchasing power. Look at the geopolitical tensions. Look at the de-dollarization efforts. This isn't conspiracy theory. This is just reading the news and connecting the dots. And silver, because it's both a monetary metal and an industrial commodity, because it's in short supply and high demand, because it's been suppressed and undervalued for years, sits at the intersection of all these trends. Now, I want to be clear about something. I'm not telling you to go all in on silver. I'm not telling you to bet the farm. I'm not promising that you'll get rich quick. What I'm telling you is that there's an opportunity here, a structural opportunity based on fundamental supply and demand, an opportunity that most people don't understand because they're looking at the wrong things. They're looking at the paper price. They're looking at short-term charts. They're listening to analysts who don't understand the physical market. They're making decisions based on incomplete information. But if you understand what's really happening, if you understand the difference between paper and physical, if you understand the structural deficit and the industrial demand and the monetary implications, then you can position yourself to benefit from what's coming. And that's why I'm telling you to stop and watch this before you buy. Because buying silver without understanding these dynamics is like playing poker without knowing the rules. You might get lucky, but you're probably going to lose. So take the time to educate yourself. Understand what you're buying. Understand why you're buying it. Understand the risks and the opportunities. And then make an informed decision based on your own situation and your own goals. Because here's the truth. The silver market is going to do what it's going to do regardless of whether you participate. The structural forces are in motion. The deficit is real. The demand is real. The paper market leverage is real. The only question is whether you'll be positioned to benefit from it, or whether you'll be watching from the sidelines wishing you had understood what was happening when you had the chance. And that's not about fear. That's not about hype. That's just about understanding reality and making rational decisions based on that understanding. So before you buy silver, make sure you understand what you're really buying. Make sure you understand the difference between paper and physical. Make sure you understand the timeline and the thesis. Make sure you have a plan. Because this opportunity, this structural setup, it doesn't come around often. The last time we saw something like this was in the 1970s, and the people who understood it, who positioned correctly, who bought physical metal and held through the volatility, they made generational wealth. The people who didn't, who stayed in cash, who trusted the paper system, who believed the official narrative, they watched their purchasing power evaporate. History doesn't repeat, but it rhymes. And right now we're seeing the same patterns, the same dynamics, the same structural forces that led to the last great precious metals bull market. The question is, will you recognize it this time? Will you position accordingly? Or will you look back in 5 years and wish you had understood what was happening when the signs were all there? That's the decision you need to make, not whether to buy silver or not, but whether to educate yourself, understand the opportunity, and position appropriately for what's coming. Because the silver market is about to teach a very expensive lesson to a lot of people. And the lesson is this: paper promises and physical assets are not the same thing. And when the system breaks, when the music stops, when everyone wants physical delivery at the same time, the people holding real assets win, and the people holding paper promises lose. So stop, educate yourself, understand what you're buying, and then make your decision based on knowledge rather than hype, based on fundamentals rather than fear, based on a clear understanding of the opportunity and the risks, because that's how you win in markets like this. Not by following the crowd, not by chasing prices, but by understanding what's really happening beneath the surface and positioning accordingly before everyone else figures it out.